Next up, we're going to talk about bunching charitable contributions. If you haven't listened to it, a couple months back, we did an episode on can you give too much to charity? And in that episode, we talked about some of the changes to charitable giving in the One Big Beautiful Bill Act. Prior to that act, the way that it would work with charitable giving is you can only take a tax deduction for charitable giving if you itemized your taxes. So there are people out there who are charitably inclined, but because they filed for the standard deduction, they didn't get any tax benefit from doing so. And there are also people who are charitably inclined, but because they itemized their taxes, they would put some real strategy behind when and how they gave. So I'm going to give you an example of both camps and how the new One Big Beautiful Bill Act could impact them positively or negatively. Let's start with people who typically take the standard deduction but are charitably inclined. If I were charitably inclined but filed for the standard tax deduction, I would not be giving any money in the end of 2025 that I could conceivably give at the beginning of 2026. The reason for that is, as a part of the One Big Beautiful Bill Act, even people who file the standard deduction can take up to $2,000 of deductions for charitable giving. So if you, as an example, file for the standard deduction and you gave $500 to a charity at the end of 2025, you get no tax benefit for doing so. It's not an itemized deduction. But starting in 2026, that same $500 would potentially be a tax deduction based on your income level that you can now take advantage of. That's an example of someone as a standard filer who would benefit in waiting until 2026 to charitably give. Now let's give an example of somebody in 2025 who would benefit from giving now money that they may plan to give next year. The reason it would benefit someone who itemizes is moving forward in 2026 and beyond. Instead of being able to deduct charitable contributions from the first dollar that you give, there will now be a 0.5% floor that you have to clear before you can deduct any of your charitable giving. If we have a person who has a $100,000 adjusted gross income and the $500 is the only amount that they gave to charity for the year, they would not be able to deduct a dollar of that contribution because the 0.5% floor would say that they have to give more than $500 before any of it is deductible. So if they gave $600, they would only be able to deduct $100 of it. 600 minus the $500 floor based on their adjusted gross income. So if I were in that camp and I had money that I planned to give in 2026, I would consider giving it in 2025 instead. And this is also true for people who are at extremely high levels of taxable income. Because going back to those tax brackets, the tax brackets go up to 37%. So you would hope for someone whose highest levels of income is taxed at that amount, that if they gave a charitable contribution, they would be saving that 37 cents on the dollar based on that rate. However, as a result of that One Big Beautiful Bill Act, it doesn't matter if your tax rate is 37%. They are capping the amount that you can benefit from the tax deduction at 35%. Now, if 2% doesn't seem like that big of a deal, I can tell you if you're in the 37% tax bracket, every single percent and every tax deduction is crucial. So this is an example or two examples of people who might front load their giving in 2025 as compared to waiting for the next calendar year. Another option for people who are charitably inclined is before the end of the year to consider giving appreciated gifts or property. And when you do this, not only do you receive a tax deduction, you also avoid paying the capital gains tax on that appreciation. So say we have a person who has $5,000 of stock that they purchased that grew to $12,000. So there's $7,000 of gain in that stock. Well, if they were planning to give $12,000 to a charity, I know this is a very charitable person, but just go with me for calculation's sake, they would have to pay capital gains tax on that 7,000 of growth. Conversely, if they take that $12,000 and instead of ever selling the stock, they donate it to a charity, they get a tax deduction for that $12,000 donation. And now the charity takes the stock and sells it on their end, which means that you, as the donor, avoid paying that capital gains tax because you did not realize the gain. You donated property that had appreciated, the nonprofit sold it, and nonprofits don't pay capital gains tax. So this is yet another way before the end of the year, if you're trying to maximize your deductions while also avoiding taxes, to marry your investment strategy, your charitable strategy, and your tax strategy to the benefit of your finances.